We're going to change gears a little bit for an hour and a half and switch to the municipal finance arena. We'll come back at lunch and after lunch back on to the mortgage and national financial crisis. As in the first panel, we have a moderator and 3 panelists. Let me introduce our moderator, and then he'll introduce the other panelists. Joe Fichera is the CEO and managing partner of Saber's Partners, and is a visiting lecturer here at the Woodrow Wilson School. Sabers is a financial advisory firm providing innovative financial solutions to the corporate and public sector. Joe's clients have involved Fortune 500 companies, U.S. Securities and Exchange Commission, and many municipalities and governments throughout the USA. So, Joe, you're up.
Thank you very much. We on our panel today, a very distinguished panel with a great deal of experience and a broad range of perspectives to try to take this from the macroeconomic, the economic view of what you heard earlier this morning of public finance, and bring it into the state and local government, not-for-profit, and other types of the issuer, and the tax base that supports these and the charges that support municipal finance. On our panel is going to be Jack Kraft, who is a partner at the law firm of Lomurro, Davison, Eastman, and Munoz, which is a nationally recognized bond counsel attorney, and he's been in the business for about, I think, with over 200 municipalities, and is considered the dean of bond counsels in New Jersey. Nancy Feldman, who is the director of public finance for the state of New Jersey. She's responsible for all aspects of the issuance and management of the state and certain independent authorities that also sell bonds. And she manages the derivatives portfolio, oversees debt reporting, investor rating agencies, and prior to coming to the state, she was head of the municipal credit group and global interest rate swap group at Goldman Sachs, or according to the New York Times, Goldman Sachs. And Christopher Kit Taylor, who is a consultant now, but is a financial and regulatory expert, who's been at the beginning of the modern municipal market, the Municipal Services Rulemaking Board, which is the self-regulatory agency, which was chartered out of the Securities and Exchange Act of 1975, and was the executive director until just last year of that agency, as it provided the protection for investors and public interest. So what we will be hearing are views, obviously, from an underwriter, myself, and who's now working as an advisor, a public finance attorney who has represented municipalities, and a former regulator of municipal broker-dealers and a current issuer. And what we're trying to ask are, what are the structural characteristics of the market for state and local debt that have led us to suggest that there are certain looming threats to the system of public finance? So what can and should be done? I'll try to put this into context from time to time by contrasting and comparing it to the corporate sector and to the basic fundamental principles of the market that we have, which is that markets work best with transparency and with self-interest. Now, the municipal market, just in the context of what we've talked about this morning, is large. It's about $2.7 trillion outstanding, but it's small relative to the total bond market of $30 billion. It's fragmented. There's over 50,000 issuers and about 1.5 million bonds, and diverse sources of credits and assessments. And this is sort of unique in the capital structure of the world in terms of having a vibrant sub-sovereign independent issuing entity that actually sells their own debt rather than borrows from the federal government or from the national government. And so, though there are questions which will be discussed today, we're going to be discussing both capitalism and federalism which will be coming under attack. This market is dominated by individuals. Many of you here may be owning municipal bonds. About 36% of all households own tax-exempt bonds. Another third through closed-end funds. But there's a controversy about all of the credits and the evaluation of those credits, which is going to be leading to some of these looming threats, and what the rating agency's role as an arbiter or leveler or creating a commodity process, and what that may have led to, similar to the securitization market and now. So first, let me list some of the looming threats. And if they sound like rounding up the usual suspects, it sort of is. Derivatives is clearly an outstanding issue in the municipal market. Municipal credit default swaps, for example, are also created. The New York Times, and just October 3rd, finally sort of woke up to this, and with a short selling on states can pay off. And their lead said, while regulators were sprinting to save the financial system last month, someone was making a lot of money by betting against the state of New Jersey. It is not clear who, but trading records suggest that in the panic days when exotic derivatives were bringing AIG to its knees, traders were using the same kind of derivatives, credit default swaps, to profit from New Jersey's rising tide of red ink. Plain vanilla swaps also, which is simply exchanging interest payments, one floating, one fixed, are a major source of problems. S&P estimated in 2007 that they were analyzing about 3 swaps a day, or about 60 swaps a month from municipalities. And all of these swaps involve taking counterparty risk, meaning taking the risk of someone else paying you, like Lehman Brothers or AIG, over a 30-year period, which was the standard norm in the municipal market, but never in the corporate market. And what that has created is large unanticipated payments for termination as the counterparties have failed or downgraded and unexpected. And these securities were sold to issuers as a way of managing risk, but actually appear to be looking like they were simply substituting risks. In an attempt to manage interest rate risk, they took on counterparty risks, they took on other types of risks, and we hope to be talking a little bit more about how that was done and valued. Now, there are also large unknowns still out there, besides the other exotic swaptions and other types of options and sort of derivatives that will be seen. In this market, there is no standard of accounting language and consistent reporting regime. By design, there is nothing the federal government is prevented from enforcing any pre-registration as it is in the corporate market. What little regulation there is about disclosure on credits and such, there's really no penalty for noncompliance. Recently reported that 50% of the issuers in the country who were supposed to file continuing disclosure, updating what's happening, didn't file, and nothing happened. No regulatory action, no market reaction, nothing. And there is, we said, when I may talk about transparencies in credit default swaps, as you've heard earlier today, and it continues in the municipal market, there is no transparency in the use of these derivatives or other instruments by the municipalities in question. And then we'll think about some other looming things you may not know, but there are major federal, civil, criminal, and regulatory investigations underway in this market. They involve bid rigging in the swaps and guaranteed investment contracts. There are anti-competitive actions by dealers in derivatives being investigated. And the auction rate securities, which is a particular favorite security of mine, and I've been critical of for many years, imploded earlier and has been under major source of financial stress for the issuers and have been keen interest of investigators and attorney generals on behalf of investors, but oddly enough, not by issuers against broker-dealers. Only one state is actually suing a broker-dealer related to the auction securities. That's the state of New Hampshire. But that's a separate question which we can talk about. But there are these things swirling about. One of the other threats is clearly with the consolidation and bankruptcies, there's now a diminished market access for to investors by issuers. There are fewer channels of distribution through the bank failures. There's less competition for these types of securities, which will, in basic market principles, fewer competitors, fewer people bidding, higher costs. There's also been this incredible evaporation of the bond insurance, AAA bond insurance wrap for the municipal bonds, which was a great facilitator of the market. With the downgrade of most of those insurers, there are no longer credit enhancement available for those types of securities, and it has created a tremendous stress and continues to stress, as just the other day one insurer went from AA rated to was it Baa2 or something like that, which is what we call cliff risk, is the uncertainty of not just going down steps slowly. Your credit score goes from 790 to 770 to whatever. It's going from 790 to 400. And that kind of risk creates a certain amount of fear in the marketplace, and which creates, again, a stress and looming threat. Finally, you looked at the competition for other types of credit enhancements, bank facilities and such, and Nancy will be talking about this in terms of her presentation about accessing lower cost securities at floating rates, like 1 year, similar to like a 1 year adjustable mortgage where you need to have some higher payment guarantee. The market has dried up, and there's greater competition with other corporate entities and for scarce resource. And all the while, we've had an increase in capital needs for infrastructure expenditures and for other expenditures like unaccounted pension fund obligations and liabilities emerge. And so you're going to see a tremendous amount of deficit type of financing wanting to go back to close budget gaps. And in this process of all the $2.7 trillion that is outstanding, the derivatives that have been thrown in associated with that, there's also a thing called options. Many of the security, almost all of the long-dated securities that sold by municipalities usually had an embedded call option, and where you could refinance if interest rates went low. Now, those options have value, and managing those options is an important aspect of a portfolio manager's view, but in the municipal market, it's not really seen as and analyzed in the same way as a corporation analyzes option valuation. And as a result, a lot of the optionality is dispersed, used up in types of refinancings that meet different types of targets that don't meet basic principles of finance. And finally, I'd like to quote, in terms of the auction rate securities and what might be a more systemic looming threat, is the process that state, local governments, colleges, and universities do in terms of interacting with Wall Street. It's one that's based on people and process, but perhaps summarized by former chairman of the Securities and Exchange Commission, Arthur Levin, in describing what he thought in a speech to state treasurers in August. He said, as we try to unravel what happened, it's clear that too many issuers were left in the dark. Many had no independent advisors, and those that did hire advisors often found themselves receiving advice from parties that were conflicted, since these advisors also worked as a banker in the auction securities market. Then there were those who hired independent advisors, only to find that these advisors failed to conduct thorough due diligence or rigorous oversight of the underwriters, as was their fiduciary duty. Treasurers and CFOs displayed a false trust in their underwriters and investment bankers, seeing them as advisors instead of their competitors in the capital markets. Traditional municipal financial advisors were often too complacent and lacked necessary skepticism. State and local governments far too often practice as almost an art form a go-along, get-along attitude of Wall Street. They believed what their financial advisors told them, that what underwriters were doing was reasonable and customary. The sad reality in this case is that what they were doing was hardly in the issuer's best interest. So the conflicts of interest, the process and the people and personnel, and how the actual coming to market and coming to terms with different types of securities may be the ultimate looming threat as not being robust enough to adapt to changing market conditions. In fact, when the auction securities crisis did raise itself and created a tremendous need to refinance the securities or sell new issues, a state legislator questioned a state issuer as to why are you using the same people, the same firms that got us into this trouble to get us out? Why are we paying them another fee? And the response was that we were using people who are already on an approved list. And if we think we need to change the list, we'll change the list. But that process-oriented argument is one that is, we think, at least from my perspective, is one that needs to be questioned in terms of how that works versus the public sector, the corporate sector, and what we have may have here having a major moral hazard issue in which there is a very lack of accountability. If the same advisors, the same issuer, the investor, the same investment banks continue on without much financial harm or being put into any real penalty box. Now, to get to our panel, I would like to call on Jack Kraft first to speak. And from your perspective and as an attorney dealing and representing issuers and the process that we have gone through and one of the key things that you think might be done. We'll then hear from Kit Taylor and Nancy Feldman, and then I'll come back with some other thoughts, and hopefully we'll get into a lively discussion going into lunch. So, Jack?
Good morning, everybody, and thank you very much, Joe, and I appreciate being invited to participate in this panel discussion about looming threats in the arena of municipal finance. I'd like to point out that this is a very broad topic, the whole area of municipal finance. And earlier this year, a handbook of municipal bonds was published, which contains about 1,500 pages, including about 40 separate chapters and then case studies of all aspects of municipal finance. And if any of you are like research people and you deal with or are curious about the municipal finance industry, you really should have this book. And I don't get anything for this, but I did write one of the chapters in the book, which is about the role of bond counsel in public agency finance. And it's probably the simplest of all the chapters because my role is somewhat simply described, and there are underwriters and financial advisors who have devoted their time to talk about some of the extremely complex aspects of the municipal bond industry. And my friend Kit Taylor, who spent 30 years as the executive director of the Municipal Securities Rulemaking Board, was kind enough to write the introduction to this, so I guess he liked it, and that's good. And then the Bond Buyer, which is the Bible newspaper of the municipal bond industry, published a little book review type article about it, and so I think
we know it's good.
We know it's good. Okay, I won't say any more. Okay, and I realize how little time I have because others have stolen most of our time. Right, the final thing is that I thought I was going to be the last panelist, and I was thinking, well, gee, I'm only going to have about 5 minutes, and so I was going to do more of a bullet and perhaps comment on some of the things that others said. And so he's thrown me a curved ball by asking me to be the first panelist.
Well, we're flexible enough to change.
All right. No, I'm up here now. And I'll still be brief. I still will be brief. This area of municipal finance is like the proverbial elephant that a number of blind people are invited to come up and touch and then give their impressions of what an elephant looks like. And I'm sure you've all heard this story or parable, and it's really true that each of us panelists will have different perspectives of the municipal bond industry depending on where we come from. And I think that you will find the overall presentation interesting. And I'm going to share one of my observations from today when Professor Leach was speaking, and he mentioned that the Nobel Prize winner, when he was asked, well, what do you invest in? And he said, California bonds. And because the government will never let California go under. I have a couple of observations about that. First, there have been very few efforts for public agencies to go bankrupt. And several of them have occurred in California. And one of them is ongoing right now, where the city of Vallejo, California, is seeking to declare bankruptcy because they want to avoid their pension obligations. And I'll talk about pension obligations very briefly in a minute. In 1994, there was a big scandal in Orange County, California, which almost led to a bankruptcy, but it wasn't actually bankrupt. And that was another California deal. The state of California is now in the process of issuing and trying to issue billions of dollars in short-term deficit obligations. And what is a deficit obligation? It's an obligation to make up for a deficit in the spending that they want to do. And so California may not be the best investment. And then the other thing that I thought about was this. If this Nobel Prize winner currently is a resident of New Jersey, does he live in here? Does he live in California? Okay, he lives right here. Most states provide an exemption from state taxation on municipal bonds that are issued within the state, so that if he were to buy Princeton bonds or New Jersey bonds, he would get an exemption from the New Jersey gross income tax. But he doesn't get such an exemption when he invests in California bonds. And so that's an indication of touching the elephant. You know, it depends on your perspective and your experiences. So I wanted to mention that too. Now, I was talking earlier today with Kit Taylor, and I might be stealing a little of his thunder, because we talked about a lot of issues. We've known each other a long time. We had a long breakfast at the Nassau Inn, which was very enlightening. And if we had taped it and presented it, you guys would have gotten a lot of information about the municipal bond marketplace. But one thing we agree on is this: the federal government hates tax exemption for state and local bonds. And that has been evidenced over the years. It came into being when there was first an income tax adopted by the federal government after the adoption of the 16th Amendment, which paved the way for the income tax. And after that occurred in 1913, the federal government adopted the first Internal Revenue Code. And at that time, the interest on municipal bonds was stated by the code to be exempt from federal income tax. And throughout the 20s and the 30s, whoever was the Secretary of the Treasury and other federal bureaucrats worked as hard as they could to eliminate the tax exemption for interest on bonds issued by states and political subdivisions of states. But they were not successful. And in 1968 and in 1969, federal laws were changed to provide for the taxation of certain types of bonds, even though they were issued by state and local governments. And that was dependent on what the bond proceeds were used for and how the bond proceeds might be invested. Because the federal government didn't want issuers to issue a lot of tax-exempt debt and then use that money to invest in taxable securities. That was characterized as arbitrage. You borrow on a tax-exempt rate and you invest in a taxable rate. So the federal government said you can't do that. If you do it, your bonds will lose their tax-exempt status. And then the purpose of the bonds, if it was used for a private purpose, as opposed to a school, to build a factory, they said in 1968 that that would be subject to taxation. And at that time, the municipal bond industry should have challenged the federal government because at that time, the idea of dual sovereignty held sway, namely that the federal government had its purposes and the state governments had their purposes, and each was sovereign. And so that to tax the interest on obligations issued by states and local governments would be an impermissible and unconstitutional limitation on the rights of states. In 1988, the Supreme Court threw that out, and from that, from 1988 forward, the federal government can tax municipal bonds if they choose. And that's the environment in which I operate and in which I ply my trade. Okay. I'm just going to show you that, and you who are close can read this. Whoops. 3 minutes. And of course, I didn't start yet. I'm just introducing. But I'm going to stop in 3 minutes. Okay. I'm going to say that there are certain things that can be done. One is that the federal government should repeal the 1986 Tax Act to the extent that it provides that banks are deprived of the interest to carry deduction. And that has largely eliminated banks as potential purchasers of municipal bonds. Does anybody know what the interest to carry deduction is? No one raised their hand. Does that mean that nobody does? Okay. Oh, well, he does. And he does. All right. I'm just going to say this one thing, and then my 3 minutes will be up. And this is just one of several specific examples of things that could be done in this economic crisis. When the bank gives you a mortgage or a commercial loan, where do they get the money? The bank gets the money by depositors and by people who buy CDs and other sources of revenues, and mostly it's borrowed. And when the bank makes a loan to you or to me, they can deduct the interest to carry deduction as an ordinary business expense. So if it costs them 3% to borrow the money and they lend it to you at 5%, one of the things that they deduct is 3%. However, since 1986, the federal government, which I remind you hates tax-exempt municipal bonds, has provided that banks are not permitted to deduct the interest that they get if they buy municipal bonds. So to the extent that they buy municipal bonds, they're denied this deduction. And there's a lot more interesting stuff to come. So at this point, I'm going to now revert to my original thing, which is I'm going to make comments about what everybody else says. Thank you.
Thank you, Jack. One of the things I forgot to say was that one of the process issues we thought that led to inefficient outcomes was that municipalities have to focus on conforming to complex tax rules, really as the driving force of the transaction, and less on marketing and pricing, some of the things that I'll be talking about and such. But it is a complex area, and as a result, people like Jack and others, in terms of focusing on the product of conforming, often means that we miss other things in the marketplace of price and cost to the taxpayer or to the entity paying. Now, one of the things that Congress did in 1975 with the crisis in the city of New York, where it was thought that it was almost on the verge of default, and that's when you should involve real estate, was to create a firewall called the Tower Amendment, but also which prevented the SEC from having the same types of regulatory reviews over municipalities as it has over corporations, and to create a self-regulatory body called the Municipal Services Rulemaking Board. Mr. Taylor joined that board in its first year?
Second year, 3 years later.
3 years later. And stayed there and saw it all. And now I would like to turn it from him to him.
Thank you.
Give us your perspective.
Actually, I'm addressing this whole lecture to Professor Shin. Where the heck is the? Yeah. Okay. Yeah. Got it. Thank you. No, it's right here. Okay. This is directed to you, Professor Shin, because I was educated here at Princeton, at least in my graduate work, and so I tend to look at things as an economist. I should also, as a caveat, start out by saying the four of us got on the telephone twice to prep for this thing, and if it seems a little disorganized, it's simply because the first call lasted an hour and a half and the second one lasted an hour. There is so much to talk about here that it's very, very difficult for us all to sort of boil it down to a couple of things. I'm going to boil it down to the market itself. This is where issuers go to either issue their deficit bonds or to build capital projects or whatever. I'm going to leave aside the whole question of why and how the issuers get into this market, but assuming they do, what are they dealing with? And we're going to go through some things here. And my contention is that the structure is basically broken, and it has led to some very untoward effects that we're going to see and are causing problems down the road. The market actually, as someone said this morning, it actually froze in September. There was no bond issuance, and we still have a problem. You can pick up the New York Times today. Hospitals, it's talked about in this instance. Hospitals can't get financing. Student loans can't get financing. State and local governments are having a tough time finding the money to build bridges. So let's go through this very quickly. Jack talked about the 1986 Tax Act. That was a fundamental thing. As an economist, I loved it. Where else do you get a true test case of somebody having a business model, a way of doing business, and all of a sudden it changes? Suddenly you get a whole different world confronting you if you're a municipal bond dealer. What happened is all that the muni investor groups changed. They eliminated banks, they eliminated property casualty companies, and the market relied on individuals. Some of you may be, in fact, individual investors out there, but in a sense, all of the new issuance has to go to individuals at the end of the day because you're the only ones that are paying taxes that can invest in munis. So what was happened here was that the business model for muni dealers was destroyed. And I have some great stories while this act was going on. The best one was by a dealer whose business model was to sell to small banks. One of the provisions in the act, which was very clear, small banks weren't going to buy this stuff anymore. They were going to be out of the market. And he sat there blithely through the whole year while the act was being passed. After the act had been in place for 6 months, he turned to me and he said, you know, I think I'm going to have to change the way I do business. We're not doing any business. I was truly dumbfounded. But that guy, as well as a great deal of the industry, relied on trading profits, constantly trading the securities that were out there, trading them back and forth between the small banks and the dealer community and individuals. And in fact, small banks acted as a very counter-cyclical form of financing because when times are good, they didn't buy munis, they made loans. When times are bad, they bought munis, which helped the state and local sector. As an economist, a good thing. Anyway, trading profits drop. And here's where what I say ties in with what Professor Shin was saying. And if you looked at some of his charts when you started out, what you would have seen is a little thing that started in about 1986, 1987. You see those lines start to diverge on the first 2 or 3 charts. They dipped a little bit in 1987. Long-term capital management was the reason, because dealers suddenly realized there was a thing called risk. What happened, though, throughout the 80s, and you can go back to 1980, it was actually some of the mergers that were going on with securities firms and banks. They sat there and they said, you know, risk sucks. Let's make money by getting fees. And fees are great because then we can go public, we can show a constant source of income, and we're not going to have a lot of variability by profits. We're just going to do fee-based business. And so what happened in the muni world, up until 1986, there was an awful lot of competitive bidding going on. Post-1986, the major dealers sat around and said, this is not good, so we're going to do negotiated underwriting. Why is it good? Low risk. We can sell the bonds pre-sale to individuals. We know exactly what our capital commitment is. This is great stuff, and we'll pocket the management fee. And if you're Merrill Lynch or you're Morgan Stanley or you're any one of the large brokers, you fed this stuff out through your distribution system. Actually, securities firms are very much like a pipeline company. They only make money when the stuff flows through. So they're trying to figure out the way to get this money flowing through and the transactions flowing through their system as fast as they can. But competition reared its ugly head. Essentially, negotiated underwriting between the 12, 15, 20, 25 largest dealers, it is a commodity product, and so intense competition developed among the underwriters. Citigroup, Morgan Stanley, doesn't matter. You pick the name. There was a tremendous amount of competition. People sat around, trading profits had gone to zero. They all sat there. They all went nationwide with negotiated underwriting, and underwriting management fees plunged. When you have competition, profits go down. And that's what happened here. So they all looked around at each other and they said, how are we going to get the business? We need to have the flow through the pipeline. And they went to the other side of the bond transaction. When the state of New Jersey issues bonds, or any other jurisdiction, they get all this money. They get $100 million if they have a $100 million deal. What do they do with it? They have to invest it. They have to put it to use. They have to do something with it. And so the first scandal, and the first problem was the underwriters turned around and said, hey, I'll do your bond deal for nothing. And you can report to your citizenry that it's a zero cost. But guess what? I get to invest the bond proceeds. And lately, it's I'll get to do your interest rate swap. Or I'll get to do some other tied-in transaction where the costs and the fees are not visible to the public. And the rates of return and the risks are not visible to the public. Management fees, the cost of the underwriting, for those of you who read your business section of your newspaper, you know, East Windsor issues, a township issues school bonds and says, okay, guys, it cost us 5.04, true interest rate cost, and we didn't pay much in the way of a management fee out of this whole thing. What a brilliant person I am. Not telling you what's happening on the other side of the transaction where they're trying to garner fees. So that's the problem. I'll let you read it. This is a Dilbert cartoon. Somebody asked me what it was. It's a Dilbert cartoon. And when I was a regulator, an economist as a regulator, you sat there and you saw right away the upshot of having a business model changed, intense competition because you couldn't offer a differentiated service, and what resulted was fraud. It's taken several forms. I can go through every one of them back to about 1987 is when it really started, and that was political contributions, literally buying officials. Tremendous quantities of money. It started out $500 a pop. By the time we enacted a rule in 1993 to prevent political contributions being given by dealers to issuer officials, the numbers were in the hundreds of thousands of dollars of political contributions flowing to the public officials for their campaigns. So we put the rule in place, and what do? Charitable giving. Give it to my favorite charity. You will hear, when you go through a political season, politicians saying, this one was my favorite charity. Interestingly enough, charities hold fundraisers and community events, and some of them are held during election seasons. Shocking. On the other side of it, yield burning. Yield burning was one of the really, really good ones. What municipalities are allowed to do when they issue bonds is they're allowed to invest them in taxable securities, provided the taxable securities do not yield more than the tax exempts. Joe talked about what people like Jack have to worry about. It's complying with the tax laws. So what the dealer community did is said, great, issue these bonds, Mr. Issuer. We'll do it for zero management fee as long as we can invest the bond proceeds in U.S. Treasury securities. And they buy the Treasury securities at par, okay? Then they raise the price, which lowers the yield to the tax-exempt yield, and they made a bundle on the taxable securities of U.S. government securities. You look at the dealer profits, 91, 92, 93, and even the start of 94, and you find out that the fixed income sides and the U.S. government profits for a lot of the major dealers came from the sale of U.S. government securities, and a lot of it was yield burning. Federal government stepped in, hundreds of millions of dollars worth of fines levied against the dealer community, and we thought that that was going to deal with it, but unfortunately that led to swaps, to auction rate securities, and others. There is a fundamental problem, and this is true in the muni market, and it's true in all their aspects of the fixed income markets. We have talked this morning about the housing market, securitization and the like. But very quickly, all of the fixed income markets are largely dealer markets. And I use the term in the plural because it is not a centralized market. It is individual markets, and for those of you who took a microeconomics course, it's monopsony and monopoly on the part of the dealer. He controls the thing, and he controls it in such a way that he can determine price and the size of his fees. There is a strong incentive within the dealer community, if you're in this position, to create unique products, those that are not commoditized, those that make it hard for the individual investor, issuer to compare price. And the dealer community has been very, very good at that, and the mortgage-backed securities market is the epitome of what they did there. Every one of the mortgage-backed securities is different. Every one of them is broken up in a different way. They created CDOs, they created CDO squareds, they created all the derivative products, and each one of them had different pricing. And when we heard people this morning talking about trying to compare prices, if they're all different, it's not easy to compare. So you really have a terrific problem there. Anyway, the other thing is if you make non-commodity products, there's barriers to competition to people coming in. We have another problem going on right now, and that's the consolidation in the industry, where a number of larger financial institutions that committed capital have declined. The number of munis, as Joe said, is 1.5 million different tradable commodities. There's no other market like this in the world with this many tradable different securities. And the number of issuers is huge, and they don't disclose. So here are some quick proposals. One, centralized price discovery. This is very similar to what Congressman Leach said. The point behind that, if you centralize price discovery, you tend to standardize the product, and you tend to make sure that there is not excessive profits. Primary functions issuing by state and localities should be through some sort of transparent nationwide business rather than this negotiated sale, which is an invitation to fraud. Secondary market, look, if you've got a muni and you go to sell your muni, you usually go back to your dealer to ask him to give you a price for the thing. Why shouldn't your security be offered to everyone in the dealer community at the same time? All dealers, not just the dealer you deal with. That dealer should be required to make that your sale or your purchase available to all of the others in the dealer community so that there is competition. That benefits you, it benefits everyone. Next, issuer disclosure, we talked about that. There's a way to do that, even, by the way, without changing Tower or changing the legislation. It takes a certain amount of creativity or thought to it. But the basic premise is, if an issuer wants to agree to a nationwide standard, there is no warning labels given. If they don't want to do it and you can put gradations in there, it'll finally end up with a skull and crossbones. Somebody who doesn't want to disclose and tell their investors or potential investors what's going on should have something put on the confirmation and a warning given to the investors. Look, this person isn't being straight with you, isn't telling you what you need to know. And there are national standards out there. Those issuers who agree to the national standard are likely to get a lower price. Those that don't are likely to pay. Lastly, and this is the thing Joe touched on, the financial advisors to issuers should be made fiduciaries. They should have a responsibility for their recommendations, and they need to be in a position and should be required to be able to push back against the dealer community to make this system work. I'm going to shut up and let others talk.
No need. We're on schedule. Part of what we've been talking about is that public finance and politics is sort of hard to separate. There is a phrase that often used is that between elections, money is the mother's milk of politics. And that came from Jess Unruh, who was the California State Treasurer, who sort of used that position to the most fullest extent and probably forced some of the reforms that ultimately came forward.
Cleared out an MSRP board meeting. by demanding that all the dealers fly to New York to pay him off?
Unfortunately, he's dead. He can't respond to that. But
he was from California.
I think the California investment we'll talk about is also we want to talk a little bit about pricing, because that it would make sense that unless California bonds are mispriced, which they probably are, is what he's taking advantage of. He should buy New Jersey bonds because he gets a double tax exempt station. But let's turn to someone who's actually on the front lines, who actually has to issue bonds and has had this, has overseen this. Nancy Feldman, who's the Director of State Finance. And Nancy, you have your presentation, and then we will go and hopefully we'll have a discussion about the various issues that have been raised amongst us.
It would help if we started at the beginning. What do you think? Okay. I'm standing between you and lunch. I get it. Okay. But you know, I want to just start with, I joined the state of New Jersey about 2.5 years ago after a pretty long time at Goldman Sachs, as it was referred to. I also spent 10 years, almost 10 years with Standard & Poor's, a rating agency. Lots of places that I've been are the people and the firms and the functions that I deal with today, but standing in a different place, right? As an issuer, as a government employee, looking out for what's best, or at least what we think is best. I think it's really hard for us to ever say we know what's best for you, the taxpayer, the resident, the individual, but doing our best to try and make that happen. Some of the threats that I've spent the last almost full year focusing on are fixing problems, not moving forward, not necessarily going out to make things happen, but to try and repair things. And a lot of the things that you've heard about today have caused that to happen. One of the things is, which is the first bullet on the slide, is the AAA bond insurers. I think that when I step back and consider that AAA bond insurers are on the 5 o'clock news, the 6 o'clock news, the 10 o'clock news. Did you ever hear about them 6 months ago, 8 months ago? Did you even know what they are? They were very important to the muni bond market. They were important to the mortgage-backed market, but they weren't important to you unless you owned municipal bonds. New Jersey municipal bonds, I'll do my commercial later. But I think that the important part is because of 50,000 issuers and not having everybody be a credit analyst like I've been trained to be for 25 years, people, you can't distinguish 50,000 issuers. Everybody does research on the automakers, the pharmaceutical companies, the large tech companies, things of that nature, or consumer product firms. If you put them all together, let's say maybe there's 1,000 real companies that trade, that people buy, and we're talking about 50,000 from your school district that has 1,000 residents in it to the state of New Jersey with 8 million people, and then of course California on the other side, which is the largest, one of the largest states and also one of the largest bond issuers. So AAA bond insurance came in as a way to homogenize it. You didn't have to know anything about the school district, about the state of New Jersey, about the utility authority that was providing water and sewer services. You only had to know that MBIA or AMBAC or FGIC was AAA by the rating agencies. And if you did your work on MBIA and AMBAC and FGIC, then you could buy those bonds because you know they were guaranteed. Well, guess what? Not everybody knew what was behind them. There was some transparency questions that came out, and guess what? Each and every one of these, except for the newest entrants, had insured mortgage-backed securities that had been backed by subprime mortgages. So we've just come full circle from our morning discussion of subprime mortgage and how it impacts everything. Well, it impacted the single largest credit guarantor in the municipal market. And those bond ratings started to drop when the rating agencies in November of 2007 started to question whether or not those AAA ratings were AAA. It was almost a given in the same way you think about the U.S. government as risk-free and AAA, that the bond insurers were going to be AAA forever. And we as issuers and investors took that and said, okay, I'm going to pay you today for 30 years of bond insurance so that I never have to worry about risk. Well, guess what? When you're not AAA, all of a sudden that risk arises. Because of some of the changes, I'm going to move on to the next thing. AAA is going to keep coming back in my discussion with you. Because of the changes that Jack initially alluded to, and Kit as well, from the 1986 Tax Act, and who was buying municipal bonds and tax-exempt bonds, who could benefit from that tax exemption? Individuals. And you can get to individuals directly, you can get to individuals through a mutual fund or a bond fund, but effectively that was about two-thirds, almost two-thirds of the market. But we lost the institutional component because the banks couldn't buy and others couldn't buy and benefit from it. So what happened? Creative finance came into play, and there was, if you wouldn't believe it, you'd believe it, hedge funds who were focused on municipal bonds. So one of the largest new buyer groups that emerged over the last, let's say, 5 years was hedge funds. They would buy long-term municipal bonds, 30-year bonds, and they would finance them with short-term financing. Long-short play, S&L crisis. This is a very, very typical way of financial engineering, but they helped support an enormous market. In 2005, volume in the municipal bond market was $408 billion. In 2006, $389 billion. And in 2007, $430 billion. Before that, $300 billion was a really big number for bond issuance. Not just the costs go up, but there were more buyers, there was more ability to issue bonds. We were using bonds for some of the deficit financing that Kit referred to, but also because the cost of infrastructure and the quality of infrastructure was declining and investments needed to be raised. Who helped drive that? Well, the hedge funds helped drive it because they had a demand for long-term bonds. And they could finance them with short-term interest rate. It's a good play, and they got to keep the difference minus a little bit of expenses. Well, guess what? They're not there anymore. Hedge funds, just like so many other financial type companies, are unwinding all their trades because their leverage and their financial resources have diminished in this environment. We've talked about the auction rate market. And again, that's another thing. You say, oh my God, I heard that on the news. Nobody ever heard that on the news before. What was the auction rate market? Basically, it was a short-term market for short-term interest rates on long-term securities. The state of New Jersey, we had $3.4 billion of auction rate securities outstanding at the end of 2007. Those securities had maturities that ranged from 10 to 25 years. But their interest rate reset every day, every 7 days, every 28 days, through what was considered a Dutch auction process. And I know we all understand now, perhaps some understood earlier than others. I look at Joe, and he has a very strong view, as he's indicated on this. Some understood much earlier than others that it wasn't a true Dutch auction because there was a lot of dealer interaction in the middle, adjusting rates. Well, guess what? It depends on who you talk to. Last week, you may have seen there was a report from the state treasurer's office. The state of New Jersey saved $41 million having issued auction securities before we had to go through the process of ending all those auction rate securities and converting them into other products. In fact, we'd actually saved $100 million in actual interest cost versus having issued fixed-rate bonds at that time. But it cost us $60 million in extra interest and costs of getting out of those products. So net, $40 million. We don't know if we should have saved $60 million or we should have only saved $20 million because the market itself was not transparent in a way that might have helped us better understand it. With that being said, I think that there are varying levels of knowledge of what was occurring in the dealer community, in the selling community, in the auction community as to whether that was a good product. It did save the state of New Jersey money, but we don't know if we should have saved more or we actually saved more than we should have at somebody else's expense. Oops, I'm going way too far. So where are we now in terms of the impacts? Am I on the right slide? Okay, the impacts are, if there is no, there I am, thank you. If there is no more AAA bond insurer, how are all these issuers going to issue? State of New Jersey is not going to have a problem. People know us. If you think about how many research analysts there might exist, they're going to know the 50 states. They're not going to know the 100,000 school districts. I'm sorry, that's an overstatement if we only have 50,000 issuers. Let's say they won't know the 20,000 issuers that are out there. But the state of New Jersey will eventually find a balance of market access. It's the smaller municipalities, school districts, utility authorities, power authorities, all of these can issue bonds on a tax-exempt basis, but they don't issue as frequently, they don't issue in size, there's just too many for people to know. So the absence of the AAA bond insurers has made it that much more difficult and will make it more difficult for local governments to finance. Supply and demand imbalance, without the hedge funds as a major buyer and without some change in who can benefit from tax exemption, guess what? We're going to still have more supply and more needs in this environment where capital and infrastructure demands are so high, our bridges, our roads, our water systems, and things of that nature, that our interest rates are going to have to rise. And this is where I get to my one picture. I'm very excited that I have a picture in my presentation, which is related to, oops, too far. There we go. Showing you some interest rates. Because we have gotten really very complacent. In the last couple of years, just in the last couple of years, you can see our long-term, almost 30-year average interest rate was just a little over 6% at a 6.51. That is based on an index by the Bond Buyer, which is sort of our trade newspaper, if you will. But 10-year average, 487, and a 20-year average of 555. These are very low rates. When you look at the top end of the curve back in 1981, when in fact interest rates were over 12%, even for tax-exempt bonds. Now that was a bond you could retire on, right? If you had a 12% tax-exempt 20-year bond, you could definitely retire on that one. But these rates are very low. And if you look in the last couple of years, just in the last couple of years, our rates are about 4%, in the low 4s for tax-exempt bonds. We've gotten very complacent because there was so much demand that anything we wanted to push out, there was someone to buy. Well, that's no longer the case. Our interest rates just in the last couple of months have risen to anywhere from 50 to 100 basis points. We've seen our tax-exempt index go close to 6% for the first time in a very long time. The average index close to 6%. Does it make it more complicated? Does it make it more expensive? Yes. Can the state of New Jersey, with a $30+ billion budget, absorb it? Possibly, and certainly possibly better than a local school district who has $1 million budget, and all of a sudden their interest rates to do one capital project go up to 6 or 7%. If you look over the long term, though, short-term rates over the whole average life of this chart from 81 to 2008, we're at 3.84%. That even includes the very high end back in 1981, which is when the municipal short-term floating market actually came into effect. So that's why this period of time, there was no floating rate index and no floating rate bonds in the muni market back in before 1981. So you can see that short-term rates over the long term and over all these averages here are much, much lower than the long-term rates. So why shouldn't the tax-exempt issuers take the benefit of that? Well, the problem is, right now, there were only 2 significant products that allowed the tax-exempt issuers to take advantage of short-term markets. One was the auction rate market, which we just talked about, which is gone, basically gone. Anyone who's still in it, it's because they can't get out, not because they want to be there. And variable rate demand bonds. Variable rate demand bonds require a bank, a credit bank, to provide liquidity for the buyers and to provide credit enhancement. What's happened to the credit quality of our banks across the U.S. and globally? The last couple of months have been severely under pressure. This is not a business that they want to be in. Buyers are scared to buy them, and it's charging the issuers a tremendous amount to buy that bank credit enhancement. So right now is not the time for issuers to be taking new exposure to short-term rates. But in a portfolio of however many billions of bonds, debt that an issuer would have, it is very logical And it is very good based on financial principles that you would have some short-term interest rate components. The question is, what's the product? Right now, I can't tell you I know exactly what the product is, but I think that we'll have an opportunity to see if the VRDN market, which is starting to come back into a normal trend, will be that market, but we'll have to look for credit enhancement going forward. So we've talked about most of these players, and I think I'm not going to go through each of them, but I do want to make two quick comments here. Not all issuers are equal. Some have significantly greater resources, both in terms of analytical resources and quality resources and personnel resources. And they also, such as the state of New Jersey, have been in the bond market once, twice, 3, 4 times a year maybe, whether we're doing bonds for transportation, which we're about to announce a transportation bond issue that the voters had approved the revenue stream for in 2006, open space, those types of things. So the state of New Jersey and New York and others of that sort are in the market multiple times a year. If you're going to build one school building in a suburban community, you're going to do it once every 10 years. You're not, the people around you are going to be really important. It's your financial advisors and your legal counsel, and I think that those groups need to come together in order to provide kind of the resources to help the smaller issuers to move forward. I think that the other important group here to look at is the rating agencies. There's lots of pressure, and I have been at a rating agency. I have a very strong view, which I'm not going to share all of it with you, but clearly the whole idea of it's my opinion and I can change my opinion tomorrow has not worked very well for the people who are making investment decisions relying upon that opinion. Right? The rating agencies say today you're AAA, tomorrow you're AA. Well, guess what? I've issued a 30-year bond. You've purchased a 30-year bond. You making a decision to move forward with that rating, and they get a chance to change their mind. They have to think about and learn to rate through the cycle. Recessions and economic stress are always going to occur. It's very cyclical. We look at all the charts that the economists have shown us, and there's one, every 6 months, every 6 years, every 10 years, every 6 months would be tough, wouldn't it? And it's inevitable. So don't assume that the minute the budget reserves get higher, that you should get an upgrade. And then they get lower, you should get a downgrade. You should rate through the cycle. It will create a much more stable environment from the rating agencies. How's New Jersey going to fare in the future? There are still a lot of questions. There are a lot of proposals out there. I'd like to just go to the Federal Reserve and the TARP for a moment. Even governments are out there looking for support from both the Fed and from TARP. And I think it's really important to think about it not in the context of why should the Fed help the local governments, but if you've bailed out AIG and all the municipalities who had ever done any work or had any relationship with AIG are now having financial penalties imposed upon them because AIG's no longer a good credit, but AIG is fine. I mean, that's probably, should definitely be in quotes. AIG is now okay because they've had federal support, but municipalities, transit systems are going to have credit problems as a result of the fact that AIG's credit is no longer up to snuff. So why should TARP or Treasury or the Fed bail out one part of the equation and not the rest? And so I think that you've seen and you will continue to see various industry groups and interest groups that relate to whether it's universities or states or government finance officers or others looking for some assistance for the corollary impacts that have occurred as a result of the banks and the financial institutions. I think we have to look at how we finance our infrastructure. There has been a push over the last, let's say, 5 years to look at public-private partnerships. They may be back in vogue in terms of a way to look at things, but perhaps in a very different way, not as a way to bring money into a budget, but a way to finance infrastructure and share the risks and perhaps share the rewards. So I'm going to leave it at that and let Joe bring us back together for a little bit of wrap-up and Q&A.
I think Wait, the other panel took in 10 minutes of us. But it's my professor who wants to speak on the chairman of my board. Okay, well, then that's why we said we've had a lot of disparate views here. I mean, a lot of different elements in terms of this entire process. But I think one of the things I wanted to discuss is clearly there's the need for greater transparency and understanding in terms of this and how competition is done. But there's also an undercurrent here that I don't think we have really dealt with directly is how do you assess and manage risk in the public sector in terms of looking at these things and looking at these securities and doing things. And so I just want to use the last few minutes about the process and maybe ask is the state of New Jersey have a risk management officer? Did it look at the counterparty risk? Does it look at in terms of its underwriters or advisors or in a structured way in looking at its outgoing risks? What goes on?
I'm going to turn this on. That tells you about my risk management.
It's on.
Oh, is it on? Okay, great. Well, let me put it in perspective. The state of New Jersey has about $32 billion of bonded debt outstanding, and there are 5 of us within the Treasurer's Office of Public Finance who manage that. So we issue it, we manage the the details of making sure that it gets paid along with our Treasury and budget function, as well as the derivative portfolio, which was put in place before I got there, but certainly was only done within the last 8 years. And so I think let's start with resources. A corporate treasury function that deals with debt issuance would probably have more than 5 people in it. I would suggest that we're probably understaffed, but you'll hear that from pretty much every state employee, so I really don't want to spend a whole lot more time on that.
But what do you do then? Do you rely on the investment bankers for more of the analysis?
Well, I think that the thing that we do is we encourage all parties, whether it's investment bankers, financial advisors, everyone wants business, right? They're not coming because they like me and my staff. They're not coming to visit because they're really they're just good at heart and they want to help the state of New Jersey. Ultimately, any work they do for us, they hope their ultimate reward is they get some business out of it. But we encourage them to work to help us find solutions, not one firm to find solutions, multiple firms to look at it to find solutions and help us look at various analyses. So we have resources internally, but we also look to other people to provide us suggestions. Here's the problem I'm trying to solve. How do you think I should solve it?
And in the auction securities market, while we think there was a major investigation announced by the Securities and Exchange Commission, and as part of full disclosure, I was hired by the Securities Exchange Commission to advise them in that after they launched the investigation in 2004. There was a settlement that censured them, talking about 13 banks of having not properly disclosed that they were acting in the auctions. And the SEC actually gave a speech to the finance group, widely covered, talking about problems and manipulations and discussions and risks associated with the auctions. How did New Jersey respond to all those market signals? Did they not issue? I mean, I would tell you that right after all of that, the auction rate securities issuance went up by 50%. So what did New Jersey do? I mean, in terms of looking at that, I mean, in that, putting in that information, did you issue? And if you did, why did you?
Well, I think I can't approach everything that occurred before I arrived, but I will tell you, yes, auction rate securities were issued since 2006, but also variable rate demand bonds were issued. So 2 different types of short-term securities were issued. I think New Jersey perhaps had a slightly different driving factor, which was a portfolio of forward-starting fixed-payer swaps, which I know is a mouthful, which is basically there was a portfolio, which we still have over $1 billion of it to come, of swaps that were going to start on forward dates. meaning that if we didn't issue floating rate debt, we would have to terminate those swaps. A costly proposition, and also one that means that for every dollar you pay to terminate a swap, that's a school building that's not being built. That's a road that's not being constructed or repaired. So we had to look at what are our options. We had two products. We used both products. We understood there were issues, but I'm not sure we understood to the level we now understand.
Joe, Rich said that I should just jump in because I want to just make two one-sentence statements, not specifically about what Nancy was talking about. But there is a problem because of the downgrading of insurers by the rating agencies. And one possible suggestion, which my friend doesn't subscribe to, but which I brought to the table today, is for the federal government to provide insurance for municipal bonds, thereby taking the place of the downgraded insurers. And there's model legislation out there if any of you are interested. And the last thing that I want to say is, well, it's not the last thing I want to say, but the last thing I will say. The looming, the topic was looming threats. The biggest looming threat, in my view, is the unfunded pension obligations of the various states and a little thing called other post-employment benefits, which is also unfunded and which means lifetime health benefits for retirees. And in New Jersey, these two unfunded items add up to over $50 billion, and there's no answer yet as to how this will be funded. And so that's a looming threat. It exists in other states. And for any analyst of state affairs, you cannot ignore it. That, in my opinion, is the largest, so far ignored, looming threat. Thank you.
Let's do Chris Matthews and just do 30 seconds each. What do you think the largest looming threat is?
The looming threat is that Rich Keevy isn't going to give us a whole day to talk about this.
Nancy, the biggest looming threat?
I think the biggest looming threat is the demand for infrastructure and the cost, whether it's out of the budget. If we can't sell bonds because there's no investor or there's no market, we're going to have to pay for it from cash. And if we pay for capital from cash, that means that that's a dollar that's not going to Medicaid, municipal aid, hospital assistance, any of the other very important strategic and important government functions. So the competition for capital dollars and operating dollars is a significant forward-looking challenge.
And I think the biggest looming threat is a government process that isn't robust enough to be able to respond quickly and evaluate risks properly and negotiate in its own self-interest, and relies on more outsourcing of analysis because of restrained resources to people who have a direct conflict of interest, investment bankers and underwriters, which I was one, and to financial advisors who do not have the incentive or have not been as aggressive in protecting their clients' interests because they really haven't been seen as asked to do that. So I want to thank, that's my summation, and I'd like to thank Mr. Keevy for giving us this opportunity to come together and talk about this. But you'll see that this is something I think will affect your pocketbooks. It's under the radar screen. It's going to come up from time to time. And it is something that we hope will not be like what Winston Churchill said about men. He said, men are occasionally stumble over the truth, but quickly pick themselves up and hurry on as if nothing has happened. We hope that stumbling, that we shouldn't let a crisis go to waste, so that this might be a time for actually to have some better reforms at the state and local level, not just the federal level. Thank you.